Okay, we'll be going through, hi, good afternoon, students. We're going through a very short topic this afternoon because we've wasted a lot of time already. So we're going through a very short one that wouldn't take much of our time. The last class we had was on trial balance and our ledger account and how to prepare a trial balance from a ledger account, from a ledger account actually, yeah. So today we'll be doing bank reconciliation statement. Bank reconciliation statement. Okay, yeah. So what's our bank reconciliation statement and why do we need our bank reconciliation statement? Now, we have, for heavy businesses, we have two sets of accounts. It's either we are running a cash transactions or we are running bank transactions. So bank transaction occurs where we have to make transfers, bank transfers, we issue checks, we make we do bank drafts on behalf of the company to a customer. In those kind of cases, for a cash transaction is within the control of the organization, because at any point in time, you know what you're giving out as an outflow and you know what you're getting in as an inflow, because you only have a record of these transactions as when you received cash. But here it is not the case, because it is bank. There will always be a, for the company or the business, let me put it, the business on one side, we have the customer or vendor on the other side, slash vendor. Then there's always an intermediary called the financial institution. If you remember when we are dealing with our users of accounts, the financial institution, which is usually the bankers. So in such scenario, a whole lot can happen. We can have a situation whereby a business might say, oh, let's give a check of so amount of money to a particular customer for supply, or to a vendor a customer might bring cash, might bring check, might pay in check like this, or the business might decide to pay a vendor by check. So in those kind of scenario, there's always an intermediary. So that intermediary is always an hinder to the transaction that flows between the business to a vendor or the customer to the business. That's the basis why we are always having a situation whereby there's a need for us to do a recall. Because at any point in time, if I am having it in my mind that, oh, this person I'm giving, I received a check of 100,000 from so person. Yes, I've received the check. Now it's led to the bank, to the financial institution, who is usually the bank, to say, oh, this check can actually fly. Oh, sorry, something is wrong with this check. We have a lot of circumstances that is actually binding a check for a bank to accept or denounce such checks and say, no, this check cannot fly. Oh, this check is fine, we can go ahead and make the payment. So in a situation whereby a business is making payment to a vendor for a check of 100,000, is led to the bank. We have a situation whereby the check is not properly signed or the check is not properly issued. Those kind of scenario are that can actually hinder that check from flying. So in such situations, we have the business, a situation whereby the business would have recorded ordinarily and say, oh, I issued check book, you say you issue check of 100,000 to somebody. For example, the customer account. You are owing the balance brought forward for the customer, maybe say 200,000. You already have it in mind that this 200,000 you've paid check, but you've paid a check of 100,000. But when you get and the amount you are owing the customer is on the balance you are owing the customer now is 100,000. I'm sure we still remember how we close our accounts. Then we come down here and say our balance brought down to 100,000 naira. So look at it in this instance now. To the business, I'm not owing this customer 200,000 anymore. I've issued a check of 100,000, but the amount I'm owing is just 100,000. But when you get to the financial institution or your bank, probably your bank will just come and tell you, oh, sorry, we did not remove the 100,000 from your account due to one or two circumstances, which could be as a result of maybe a low balance on accounts. When there's a low balance on the accounts, or you have a situation whereby the check has been issued for a very long time, the customer has refused to. So we have a situation whereby the customer did not even present it, unpresented. The check was not presented, or we have issues around issuing the cash, issuing the check, whereby probably the check date or signature does not rhyme with the one on the account and all. Those are the kind of scenarios that can actually bring about, oh, sorry, we cannot pay this money. And to the business, we've already paid. So those kind of situations, we always have issues around what is in our bank account and what the company itself, the organization is having as its own balance in the account. So the issue is always around two major things. That's the bank statement. The bank statement in the bank, the bank statement, and the bank account. So note that this bank account is the account, that's the account that is meant the business. You tell them, let's see, this is what they have. It's different from what is in the bank statement. This is what the bank statement. So a bank statement from the company's account. That's what the bank statement will always do. Inflow and outflow from the company's account with the bank. The company's account with the bank. So let's note this. Don't let us mix these two things up. But the bank account, that's the inflow and outflow. The inflow and outflow in the accounts, in the company's account. With the business. So one is with the business and the other one is with the bank. Because they are not magicians, definitely they will need a scenario whereby they will say, oh, sorry, there was a time you actually had issued out this. There was a time you actually received it. But you have received it, you have issued it out. But on our own part, we don't see it that way. The only thing is that we only recognize inflows and outflows based on how we receive them, based on how we give them out. It's not on the assumptions that because the business said go ahead. When we don't do actual cash flow, the bank will not affect it in your statements. But the business will just say, I've done it, that one too is fun. I don't want to have anything in my head regarding it. But regardless of how it is, the bank is always in a position whereby because they are third party, they want to be very sure, they want to be very careful with people's money. So they don't just make assumptions. So in such situations whereby we have these differences, in such situations, there will always be a difference between the bank statement and the bank account with the business. So definitely there's a need for a bank reconciliation. So what are the things that actually bring about differences in the bank statement and the bank accounts with the business? So those kind of situations are, number one, we call it dishonor check. I think that I was trying to make honor check. What do you call this honor? You've given out, I just want us to get this concept, the definition to this concept. You've given out a check to someone. They'll go ahead and make payments or payments or as a receipt. So these are the circumstances that are actually binding this check not being captured. We can have a situation whereby the date does not correspond. When the date does not correspond, we might have a situation whereby there's something we call stale check. When we say stale check, those are kind of situation whereby the check has actually been issued for a very long time, usually more than 6 months. But aside that fact, I've seen a scenario whereby the date on the check was supposed to have been 14/01/2021, and the person that issued the check mistakenly wrote 14/01/2020. Even if the check has been issued, it has passed through all the levels of authorization without anybody seeing that the check is 14/01/2020, and we are in 2021. Well, like the bank is going to return this check, they are not going to accept it. That one is another thing. Then again, another scenario could be signature, where the signatories to the account have not signed proper, or probably they couldn't get all of them to sign at a time, or the signature does not even match what the signature at the time the account was opened. That one is another fact. Then we have another scenario whereby the amount in words is not the same with the amount in figure. So that one is another scenario. I'm giving you instances whereby you can dishonor check. A whole lot can happen in between, or probably the date at which the check was given is different from the date you were supposed to cash the check or actually receive the check. Is different from the date that they actually brought the check. So that one is another factor. So those are this is actually happen. I'll bring about the fact that they should just decide they cannot accept this check. That's a dishonor check for you. And you can imagine at that time, the business will be saying it like, I've paid this person. Whereas a whole lot is happening with the financial institution. They'll be like, no, we are not giving you this check. We are not accepting this check. Then there's another one, unpresented check. Unpresented check. There's nothing wrong with this type of check. Everything is fine. It's just that the person decided not to present it. So it might be the business has received the check, or the business issued the check to a customer, to a vendor, and the vendor will just be like, let me still hold on to it. I'll go and check. I'll go and do it later. Then the later till when, or even God knows. But the business, they'll be like, I'm not owing Chukwemeka 500,000 again. What I'm owing to Chukwemeka is now 300,000 because I issued a check of 200,000. It's a lie. Whereas the man has not even presented the check at the bank for payment, for the payment to have been effected from the business account. So the business account, you can imagine those kind of scenario. The business account will now be looking more than the business bank accounts. The account with the business in their own office will be looking lesser than the bank account in this with the bank gongo, because it will just be like, no, why are we having a difference? That's the kind of scenario, because at the end of the day, the bank will be having balance as per bank statements. When they have balance as per bank statements, you'll be seeing something like 300 naira, and you are saying balance as per bank account. The bank account the company is maintaining already, seeing 200 naira. It means they've actually issued out a check of 100 naira, but the person has not presented it. So in this kind of situation, that's the basis for this bank reconciliation statement, because you have to now to say, oh, everything is fine. You have to reconcile everything in a way that will match the company's the bank statement, or in a way that it will match the company's bank account. Depends on how you want to go, how you want to do it. But regardless of how it is, you should know which direction you're facing per time. This kind of scenario now, the bank is having 300 naira, and the bank account with the business is having 200 naira. Definitely, the 100 naira difference is the unpresented check. For this one, in this kind of scenario, if you are actually looking at, we are trying to reconcile to the bank account, you just say unpresented check. You come here and say unpresented check. You say 100 naira, right? You just remove it, so that we'll be able to have a balance as per bank account 200 naira. But I don't want us to have a situation whereby we'll be mingling this thing around. You should not at any point in time, for what point are you moving to what other points? When you have that in mind, you'll be able to see how you want to go around this thing. Because if it is balance per bank account, you are trying to reconcile to balance as per bank statement. It means you had this 200 naira to 100 naira to make this 300 naira. But it's because we are doing balance as per bank account to the business, and we are giving the balance as per bank statement. That's why we are deducting unpresented check. So note, there are instances where you can add unpresented check, and there are instances where you can deduct undependent or unpresented check. Depends on the circumstances. What balance are you trying to reconcile? Please don't get this clumsy out. Like I always say, this class is just to make it easy for you. So by the time you'll be going through your study text alone, you should be able to. It will give you more give you more in-depth knowledge about how this whole thing goes. You can start with balance as per bank statement, and you can start with balance as per bank account. Just know which one you are starting with. But if it is balance as per bank statement, you know your unpresented check will be deducted to get your balance as per bank account, because the bank account already issued out this check, and they are assuming that they've received the check. So when you see your questions, the first question is, who is this? Who has taken the effect? Who has taken the effect into place? Is it the bank or the business? It can be the business, it can be the bank. But regardless of how it is, you are trying to achieve one thing. You are trying to say the bank is not lying, and the bank is trying to say the business too is not lying. So we have to be really clear about what direction we are moving. It can really go up sometimes, and then it can really come down. We can't say which one at any point in time, but we have to be really clear. So we might start with balance as per bank statement, or balance as per bank account. But regardless of which one, you have to be clear with it. Then we have something we call uncredited check. Yeah, this is the other one I was explaining. Uncredited check. So unpresented check, let's make this easy. Unpresented check is always with your vendor. The check you issue to your vendor. While uncredited check is the check you received from your customer. So then you're saying unpresented check. Your vendors have received the check, but they refuse to take it to the bank. go and for the account to be credited. Sorry, debited at any point in time. But uncredited check, the business itself has received the check that they as a medium of payment, but they've not taken it to the bank, or probably they gave it to the bank and the bank has not credited it, but they have captured it as payment, as a payment that was received from the customer. Please note this thing: your unpresented check, any day, anytime, is always with your vendor, people you are paying. In case you don't, let me put it that way: people you are paying. You know, when you are paying your vendor, these people you are paying is what this unpresented is meant for. Then people that are paying you, people you are receiving money from, is the uncredited check. So that's that about it. Then we have something we call standing order. This standing order, it's just a situation whereby you felt, oh, every month you want to be committed and you want to be a good person. You don't want to owe anybody money. You're not like, okay, for this loan I'm receiving, take for example, if you receive a loan, take for example, it can be a NEPA bill, it can be any form of utility bill. You just talk to your bank. Hello, banker, please, at any point in time, at the beginning of every month, please make sure you deduct 1,000 naira from my account for so person, for so expenses, for so. You can be anything, but it is a standing order because you gave the order that go ahead every month, deduct my money. Go ahead every month, use my money for this thing. And go ahead every month. So you that you're giving the order, you've forgotten you gave the order. So the next thing that will be coming to your head is, what happened to my money? How comes my money has reduced like this? Then the bank will tell you, this is what your statement is looking like. You not be like, no, this is not what my bank statement is. Maybe at that time, your bank statement is saying 1,000 naira. And you, in your home books, in your own bank account, the one you maintain with yourself, you are seeing 900 naira. They'll be wondering, how comes? What did you guys use 100 naira for in my account? Then you'll just be like, well, there's a standing order which you say, where you give an instruction to have 100 naira deducted from your account at any point in time. When did I say that? Okay, if that's the case, no problem. Then you guys now come. Okay, let's reconcile as per bank statement. If you are reconciling as per bank statement and the bank statement is saying 1,000 naira, then you will now tell the bank, okay, sorry, I'm so sorry, I missed something up here. Okay, let's say this one is 1,000 and your bank account is 1,100. Sorry about that. So in such situations, they are saying your bank statement is saying 1,000 and your bank account is saying the one we have with your business 1,100. It now depends which one are you trying to reconcile. So if it is your bank account, you are trying to reconcile your bank account balance to your bank statement. It means your standing order will be deducted. You say standing order. So you need to understand this first. You just say 100 naira, you deduct it. The balance will give you your what? 1,000 naira, which will be your balance as per bank statements. So there's no single format for this thing. Just know what you want to do part time. Which one affects your bank statement and which one does not affect your bank statement. Just know which one at any point in time. Because regardless of how it is, you will notice that this one is your bank that will take care of it. This one too. Your bank would have done whatever they want to do before you realize it. This one is only you that is having it in your head that is happening, but the bank is not even aware because they don't have it. This one too, the bank is not aware. The only thing that the bank is always aware that they are doing is like this this standing order. Then there's something we call bank charges, where the bank charges you for every little thing they do for you at the end of the month. It's more of like this standing order, but it's not really standing order. we have bank charges. But for every transaction you do with the bank will surely charge you. They won't tell you, hello, sorry, we want to charge your account. No, they will just remove their charges. Now it's not left for you to say, oh, at any point in time, oh, this is what my account balance is saying in my books. This is what the bank statement is saying. We need to reconcile in a way that will match with the bank statement. Or you tell the bank statement, oh yeah, bank statement, bring your statement. Let's reconcile this thing to make sure that it's right, it tallies with what we have in our own books. So that's another one. Then we have a situation whereby there's something we call direct payment. Well, direct payment is just like this standing order, but it's not really the standing order thing, because this one, the bank just decided to make. It can actually be from the bank, can also be from the business itself, that they just decide to say, oh, let's make this payment directly from our hand. Let's make this payment directly from our hand. Let's make this payment directly from our hand. So it's in such situation, it's something like that they have a consensual agreement to say, oh, go ahead and do this payment. But we have a situation already whereby one party to the agreement has actually forgotten, oh, we are supposed to make that payment. So those kind of scenarios too. It's just for us to understand what exactly has happened at any point in time, for us to interpret, and it will be easier for us to reconcile with the bank at any point in time. So we have another scenario, like we have a scenario for, let me just put it here. Commission interest. Commission of interest. So they are always like an interest income or commission. It's different from expense, because if you look at this one, this one is an expense. Standing order is an expense. So uncredited check is an income. This one is an expense. But this commission or / interest can be income. Most especially is an income, because it's always a situation whereby if you have enough money in your account with the bank, and they just looked at it, maybe they've traded. In fact, it's not like maybe they've traded with your money enough to say, oh, you are entitled to an interest or commission. That's the amount you now see in your account. You now be wondering, what did I do for the bank that they are giving me money? So in those situations, that's the situation whereby we have interest income, because the commission, the interest is normally interest income. So it is always in form of an income. So at any point in time, please, if we can have an idea of what each of these things would have done, each of these things would mean, it's just a way to guide you on, oh, if I have a balance with my account, if I'm having a balance as per bank statement, I know these are the set of things I'm supposed to add back. These are the set of things I'm supposed to deduct to have the same balance as my bank. Then we have other scenarios, like we have, I don't know if you guys can see it from down here. We have errors that have made errors by the bank. The bank can make so many, they can make errors because nobody is above errors. This one is, as we have a direct payment. Let me put it, direct debit / credits. So I was explaining this to be two-way thing. It can be a direct debit from the bank, meaning they made payments on behalf of the company without the company is aware, but they don't really have it at the back of their mind that has happened, or they have a direct credit. So someone will just go to the bank and just make payments. So it's different from a check that was made here, a check that was received here, on behalf of it from a customer, but they've not taken it to the bank for payment. So we have that with that situation, and it can actually be, it can be a two-way. We can actually have it or as an or take it. We've taken it to the bank, but the bank has not effected it. But it's different from this one that says direct debit or direct credit, because this one you are giving cash, you are giving a check in those two instances. But this one is usually bank transfers, because they will just debit, they will debit it from their end. The bank will just make payment to the customer on behalf of the company, or the company, the customer will pay to the bank, directly to the bank on behalf of the company, without the company knowing. So it's a two-way, it's always a back and forth thing. But one thing I just want us to take into consideration is a situation whereby we'll always want to look at it and say, oh, if this is our bank account and these are the list of things that we've been given, we should be able to say per time, oh, this is what we are supposed to do, this is what we are supposed to add, this is what we are supposed to deduct in order to have a single balance. So for error at the bank, we can also have overstated. The bank might erroneously overstate a value or understate a value. So it's just left to us to say, oh, what are we adding? 1 plus 1. Which 1 plus 1 are we adding that will give us 2? Because ordinarily, if they give you a situation whereby you say 1 plus 1 equals 2, and you can count how many numbers of things you should count at any point in time, I'll give you that value. This explanation goes a long way to tell you what it is. Like I said, it's an honor check. The company would have made the payment or has received the check, would have raised the check or have received the check, but they were dishonored due to 1 or 2 circumstances as explained earlier. Then we can have interest received or commission received like this in our bank account, but we are not even aware. So it's later on we are not coming to realize that, oh, they paid money into my account. So it's not left for you to say, oh, definitely they paid money into my account, I should add it to my account to balance it off against what the bank statement is saying. Like in the case of this dishonor check now, I think we should just take it little by little in front of each other to say, if it is with the bank balance as per our bank account, if you are going to reconcile the balance, the dishonor check as balance as per bank account, you already had it. It's either you've added that value if you are receiving it, or you less that value. If you have added that value in your own account, by the time you want to reconcile to your bank statement, you need to go and remove it back. You less it. But if you have deducted it before, it means you have to what? You have to add it back. That's the treatment for this one. It's a two-way thing. It can either be added before or less before. If it is a check that was received as an income, you have to what? If it is a check that was received as an income, because you've added it, you have to deduct it so that it will balance up with your bank statement. But if it is a payment that has been deducted before, you have to add it back so that it will rhyme with your bank statement. So that's that for that. For your interest income, your bank account does not even know what is going on. So it's not even there. It's only your bank statement that knows what's happening. So if it is your bank account that does not know, because it's already in your bank statement, if you are reconciling from your bank account, you add it back. But if you are reconciling, there's no way you have to add it back. If you are reconciling from this place to this place, towards this direction, you have to add. Use that pattern to make it easier for everybody, because this bank statement can be, I know it can be trickish, but at the same time, in as much as you know what you're doing, it's not that hard. It can be really trickish. Depends on the format you're trying to use. I don't understand why all these pens are so going. So you less if you are going from the bank statement to the bank account, because the commission has been recognized in the bank statement, but the bank account does not have it. But if you are reconciling from your bank account to your bank statement, you add. That's just the logic there. So for unpresented check, if you are going from your bank account to your bank statement, because it is an unpresented check, a check that the bank account has actually recognized that, oh, I've given this person money, then in such situations, you have no choice than to recognize it. So if you are going from bank account to bank statement, you have to deduct this unpresented check. But if you are going from your bank statement to your bank account, you have to add it. That's just one logic. So just know what you are adding and what you are deducting per time, because it might not work at the same time, the same way. So the next one, the uncredited check. You can have uncredited check is always a situation whereby the bank account has recognized it, but the bank statement has not. I was using a marker here. I just hope my next class will not be this bad. Seriously. So the bank statement. So the bank account has already recognized it. Bank statement has not captured it. So if you are reconciling from your bank account to your bank statement, you deduct, you less it. But if you are reconciling from your bank statement to your bank account, you add it. And in fact, I'm going to do I'm going to draft something big on this, and I'm going to send it out to the students so they will understand how to really go about these things without having to do a lot of wahala I'm doing at the moment. So if you are having a standing order is an expenses on its own, like we all know. So if you are reconciling from your bank account to your bank statement, because it's a standing order, if you are reconciling from your bank statement to your bank account, you add it back. But if you are reconciling from your bank statement, from your bank account to your bank statement,
but please, you have 7 minutes remaining.
All right, I'm wrapping up because what I want to do here, I want to drag this out and share it. Like, I know my marker is really bad, like really bad. So I want to make this class as simple as possible. So each time the students go around the studies and like go around the study text, they will be able to understand more clearly. And again, your bank's reconciliation statement, I know, can be really tricky. I know it's really tricky because then when I was coming up myself, I look at it and say, oh my God, how am I going to cram all of this? But in as much as you have all of these things at the back of your mind, you should be able to know what to deduct and what to add at any point in time. Then this direct debit and credit is more of this unpresented and uncredited. So the treatment is still the same way as your unpresented check and uncredited check, because at the end, at the bank's end, they've actually added it straight up. But the reversal is the case in each of these. So if you are reconciling from your bank account to your bank statement, the next week, inshallah, we'll be able to go through an in-depth analysis, because we'll be having an in-depth class. We'll be solving a whole question on bank reconciliation statement. So it's not just an assumption. But I'm sure by the time we go through the class for this one, the topic, the explanation we've made on bank reconciliation statement today, it will make it more easier for us to go through bank reconciliation next week, especially when we are having a class. And then please, I want the how am I going to call it now? Please, I want the coordinators to make sure we are on class. This class starts at least 10 to 15 minutes before. Reaching out to me as exactly one who really freaked me out, and exactly what happened to me today. It really freaked me out because I totally forgot I was having a class. So for direct debit and direct credit from the bank, and the bank account is not aware, you have to debit, you have to add back or deduct, depends on the case. Like this direct debit for the bank account, you have to add. Yes, you have to deduct. For the debit, you have to deduct. While for the credit, you have to add. But for when you're reconciling the bank statement to the bank account, the reversal is the case. Then error made by the bank, overstated and understated as the case may be. I'm sure by next week we should be able to see more questions and see why the error used to happen. So when we treat a comprehensive question on that, we should be able to, that would enlighten our knowledge, our knowledge and everything we have been trying to explain. It will broaden it up and we see why those things happen, that they don't just happen like a magic. It's actually a reason. I'm sorry. So it's actually from one reason or the other. So I will leave this class to the coordinators, and I hope next week we'll be able to have a comprehensive question. Then we'll be able to solve a comprehensive question on this. Inshallah, next week, may Allah spare our lives. We should be able to solve a comprehensive question. And if we are not, I'm sure my other colleague will be able to take this up. Thank you so much. I don't want to waste much of our time.